I'm just a backwoods boy from north central Idaho. I grew up in Kami, Idaho. My business experience is in retail grocery. I started as unloading a freight truck and worked there for 13 years and worked my way up to manager before leaving that store and managed another store. And then my wife and I moved to Lewiston to get re-educated. And in my second life, I have been at CEDA for 26 years. If you didn't pick up on it, once they let me in the door, it's hard to get me out. So anyway, what I do at CEDA is we have small business loan programs that are intended to finance projects that don't quite qualify for bank financing in one way or another. That can be the entire project or just a portion of the project. Or we partner with banks, or we do projects on our own at times. The key is the money we lend cannot be available from a bank or a credit union through normal sources. So that's hurdle number one for me, is to determine why CEDA would need to make this loan. CEDA is an Idaho organization. We're the SWEDA counterpart, if you know about SWEDA, which is Southeast Washington Economic Development. CEDA is Clearwater Economic. We're established to serve north central Idaho. SWEDA doesn't have loan programs. Our banking community that's centered in Lewiston, Clarkston, Moscow, Pullman that's why we serve Southeast Washington, is to help them. If you noticed on the handout, there's on the back a list. CEDA is a membership organization. Most of the banks in the area are members. They provide volunteers. Our loans are loan applications are reviewed once a month by a group of volunteers, and those are volunteers from the banks. So they're heavily involved in us. But I'm really not here to sell you on a CEDA loan. As I tell people, I don't sell people on borrowing money. They need to sell me on loaning it to them. So if you need us, great. If you don't, that's great too. But we also have money for technical assistance. So if you have a business question about financing, which is my area of expertise, I'd welcome your call. USDA funds our technical assistance efforts through the Rural Micro Entrepreneur Assistance Program. So anyway, I have a list of things here that I thought might be of interest to the group, but I wasn't sure who was going to be here today. So like I say, if you don't ask me questions, I'm underprepared, because I picked up on the fact that everybody in here is in business pretty much. CEDA works with a lot of startups, but we also do expansion. So I have done numerous expansions, and I work with a lot of bankers. So I might give you some inside information if you ask. Because one of the main points I wanted to make today is not all bankers or banks are created equal. What they really asked me to talk today about was when it would be appropriate to take on business debt. And that's going to vary a lot, but one of the key things you need to do right off the bat is have a banker that you can work with. When I was young and foolish, I used to think that they wouldn't loan me the money if I couldn't afford to pay it back. That's not true in all cases. So you need to have a good banker that you can work with, that knows your business. Since you're all in business, probably the bank that you have your accounts with is, if they have a commercial lending department, that's who you should work with, because they know your business. But not necessarily. Again, not all bankers are created equal. But the main question was when to take on business debt, and that's really going to vary person to person. Your level of risk tolerance is important. Your personal goals, your wealth building strategy, and ultimately your succession plan. What's the plan for your business going forward? Is it you want to hand it off to your kids after you've run it for 30 years, or do you want to sell it and make a big profit, or what is your plan? Some people would just want to build equity in they want their business to build equity in the building that their business is in, so that's their retirement plan. That might be part of your deal. That was Wendy's strategy, by the way. He wasn't really a restaurant operator. He was a real estate owner. Anyway, but it matters whether you want to retain control of your business, or whether you want to welcome investors. One thing I would caution against is to avoid partnerships, if at all possible. Sometimes they work. I've financed a lot of partnerships in my 26 plus years with CEDA, and most of them failed. The partnership failed. Not necessarily the business, but that will drag down your business in a heartbeat. It's worse than a bad divorce. So
the nature of trying to work with someone in that, is it the relationship that falls apart?
yes, usually. An example that comes to mind, a couple young ladies, they had been in the fitness arena for quite a while. They wanted to open their own gym, and they did. And their friendship lasted about 12 months. The business is still operating. One of them bought out the other one, but they're no longer friends. So I'm working with a couple guys right now, and one of them told me the other day, "Oh, that's my buddy. He's not going to do that to me." Excuse me for saying so, but I call BS on that pretty fast.
What do you attribute that to, John?
Attribute the
The
failing of the partnership?
Yeah, friendship gone awry in the business.
Unrealistic expectations going in. They didn't sit down and talk it out. They talked, and each one left the conversation with what they thought the answer was, but nobody sit there and wrote it down. So, as you think about things, at least I do. I refer back to my notes. Am I really on track with what we agreed to? And that's usually what happens. They don't do that because they trust each other, and that's fine. Best way to protect that trust is write it down.
I've always heard that a two-person partnerships fail, but then does your odds of success and friendship increase when you add to 3 people or 4 people or 5?
Well, the only answer I can give you, Adam, to that one is my personal experience would suggest that yes, a bigger partnership is going to probably survive. It's more likely to survive than a 2-person partnership. But I've only really financed one business. They had 4 partners, and each one of them brought something really important to the table. The other 3 really couldn't get by without it. If one of them left, that was a big dent. They made it work. I think that's more because it's more like it's almost like stockholders. It's a different relationship. And it probably has something to do, to be honest with you, that somebody in that group of 4 people said, "We got to sit down and write this down." So they did, and as I remember, one of the 4 did eventually leave the company, and they replaced him. But that was years later, and that business is still going after probably 10, 15 years. So, investors, of course, would be the alternative to financing, which is you're going to give up control one way or another, whether that be your partner or taking on a silent partner. Most people start with family money. I don't know if that's the case here, but I would recommend trying to wean yourself from that as soon as possible. But when people come to me and I'm assessing whether they should borrow money or not, the question I want to answer is, are they able to pay it back from the profits they're going to earn with what they're investing in? There's no sense to take out a loan and rely for a piece of equipment and rely on the rest of your business to pay for that piece of equipment just so you can have it. That doesn't make any sense. That unit needs to be producing profits, and if it's not, you're less likely to get the loan. And how do you determine that? Well, you got to do your homework, just like a startup or any other evaluation. You do your research, your planning, your pricing, and some analysis, and put together some projections and see if it'll work out. I'm sure you all know that. You've done it. Types of debt, of course. This is where I run into issues with that lead me to say not all lenders are created equal. Lenders are like any other profession. They have goals they need to meet, and they have areas of expertise. And it really doesn't matter what profession you're talking about. If you go there, they're going to try to sell you on what in their area of expertise. I've had people come to me and tell me that their banker's trying to talk them into signing up for a line of credit to buy a building. No. But that's all. That was the only credit that banker was allowed to approve. So that would have been a disaster. Because if you know about lines of credit, some of those require to be paid down to zero at least once a year, and that doesn't work. That's for temporary inventory. And then, of course, your term loans for equipment and real estate. Now, permanent inventory, I have financed permanent inventory, which that's essentially the dollar amount of inventory you're going to have on hand all the time. It's not that piece is going to stay there forever, but you're going to keep dollar value. That's going to be what's going to be in the store all the time. But there again, you got to make sure your profit margin and your turnovers are enough to cover the interest principal payment on that. So, and other things you got to consider, of course, are your terms relative to the useful life of the equipment. Do I have to pay the line down if it's an inventory loan, or is it a term loan? Those kind of things. So, if you are going to approach your banker, they're going to use an existing business, which we have here today. Tax returns are probably main thing because that shows your history. To be honest with you, lenders don't really want to see your internal financial statements because they're probably wrong. We want to know what you're telling the government, because you're not gonna over-report your income and under-report your expenses to the government. That's not gonna happen. Well, probably not gonna happen.
Probably not.
But if you're mid-year, like November right now, if somebody came to me, I'd have to have their current financial statement and current P&L up to within like 60 days. So it is important to have that stuff, but we're going to take it with a grain of salt. And like I said earlier, profits and ability to repay the loan, your reputation, that's kind of going back to what I said earlier, work with the bank that you all normally work with. And if you're in a stable industry and you do have organized records and you're profitable, you can probably get the loan. Now, if you've not tried to get a loan before for your business, the key is most banks and credit unions want you to be able to repay the loan with existing profits. They will not take into account the fact that that piece of equipment is going to increase your profits. Mm-hmm. Just for a standard bank credit union loan. To get over that hump, they may, if you're a good customer, use an SBA guarantee, which is how they get around that, because your repayment is based on projected profits, and banks and credit unions, that's not acceptable. At CEDA it is, but not. That's our niche. Really, we accept projected income as a source of repayment, which is really what your banker should be looking at. If they're looking at your collateral and all that stuff, and that's their biggest interest, find another banker, because they should be interested in your cash flow and your profits. If they're an asset lender, is kind of what we call the collateral folks. They might be just interested in getting your property or whatever. There's some shady lenders out there. None of these banks, we don't have a lot of that, but just be careful.
When you say stable industry, can you describe what a stable industry is? Because I think there's, in the marketplace, there's a lot of instability, but then also like specifically looking at property, up here in Pullman, a lot of the properties are, in my opinion, pretty inflated in price. How do we look at stable industries, but then also look at radical price increases? Like how do we work with that as a business owner mentally, but then also going to a bank and presenting that?
Well, stable might not be the perfect word for what I'm trying to describe, but if your industry is declining and you're not trying to pivot into something new, which would almost put you in the startup category at your bank if you were trying to pivot to something new, then there's not a lot of expectations that your profits are going to remain. You know, if the industry in general is kind of going away, then your profits are probably going to go down and you're not going to be able to repay as much debt. On the other hand, if the industry is growing like this, the question becomes, how are you going to fund that growth? Because growth costs money. And so somewhere in the middle is where most commercial lenders are going to be the most comfortable. You know, if it is a rapid growth or a pivot, they're probably going to want everything they would want from a startup, which is more of a business plan, financial projections, detailed assumptions, all that kind of stuff.
I don't know that I've talked to my banker in 2 years. And then actually, in fact, I think the one that I talked to the most left when he went to Nevada. So then for me going in and just being like, hey, I am trying to do growth. Growth does cost money. I have new contracts. I need to hire more people, but it's going to be a while before I get the money from the contract. I need to pay the people to do the work for the contract. So then do I go for larger lump sums? Because like there's buildings that I would love to buy, but I haven't talked to my banker in 3 years. Or would it be better to say, hey, I'm actually looking at buying a company vehicle and starting on those smaller amounts and trying to build that trust with them ahead for getting ready for a bigger purchase?
The trust factor is important, so if you have a history of borrowing and repaying loans, that's good. That's a bonus.
Hopefully everybody does that.
Well, I've had borrowers come to me and we financed them, the business failed, but they repaid the loan anyway, and then he sheepishly came back and said, would you loan me money again? And I said, sure. Wow. You paid the loan back.
Wow.
Bonus, big bonus. Anywho, to the building and the truck choice, my question would be, which is one of those or both of those important to your growth success? Which one's going to contribute? Would it be nice to have a building, or is it just as good that you lease one? And that's kind of my question that I would ask you. But to your question, it's kind of funny you bring that up, because CEDA's bank built a nice big building on the top of the hill and then did everything they could to keep us from coming there. It was like the next week after the guy shows up with the machine, and I do the deposits for CEDA. So I sit there at the office now and put checks in this machine. I no longer go to the bank. And everybody's going that way. So how do you build a relationship? That's a good question. You just kind of got to stay in their face a little bit. It doesn't hurt to keep your line of credit in place, even if you're not using it, because that means they got to come talk to you once a year. It costs you $150, but at least you're talking to your lender. I don't know. It's up to you how you do that, but yeah, some way. And they tend to hide these commercial lenders in the back now. I mean, that's just a trend I'm seeing. It is difficult now compared to what it used to be. But so I think I'm in a roundabout way saying, yeah, borrow some little amounts so that you keep that relationship going and have a good track record. So when you need that building, they'll do it.
And what do you consider a little amount? Is that 5, 10, 50, 100? Like what does that look like?
Well, I think the new number is $50,000 and under would be considered a small amount at most lenders. That's not a written in stone number. That's the definition of a microloan in my world is $50,000 and under, and banks do tend to shy away from those because it costs just as much money to put together a $50,000 loan as it does to put together a $500,000 loan. And guess which one they're making more money on? Keep in mind, and this is why not all bankers and banks are treated equal. Banks are private businesses trying to make a profit. That motivates what they do. It's not necessarily bad because that's what you're doing. Same thing. Yes, sir.
You mentioned earlier that we should be thinking of credit unions as well as the bigger commercial lenders. Can you
Yes.
explain just some of the pros and cons of working with like a local credit union or a regional credit union versus a national bank like Chase or US Bank?
My experience with a U.S. bank is they're not small business friendly, and generally speaking. So right off the top, I would suggest that if you're a small business, you go to a more regional bank or credit union. I don't know that there's good or bad borrowing between a bank versus a credit union. If you're doing business, nationally or even internationally, then you need a bank that's big enough to handle that. That might be why you're with U.S. Bank, because they're big enough to handle that, for sure. The credit union, like ICCU, which is one of the big ones, of course, everybody's hearing about them. As far as I can tell, their rules for lending are same as the bank. Freedom Northwest Credit Union, which has been around a little longer, just to be frank with you, we had a loan committee meeting yesterday, and I got a group of bankers sitting around the table, and we were talking a little bit about some deals we'd seen come through Freedom Northwest Credit Union, and everybody's sitting there shaking their head going, what are those guys doing? So they're doing some stuff that it's just kind of out there a little bit. It's real estate lending is what it's based on, which is banks don't tend to lend on bare land. So speculative lending is pretty difficult to get in general. These bare land loans that Freedom Northwest is doing, most of them are for residential properties or farm ground, that kind of thing. So it's not totally out there. It's just unusual. So I don't know really. Go ahead.
I want to circle back to something that Adam brought up, the idea of needing a modest amount of capital to scale up operationally. That does seem difficult to lend on because there's not a lot of collateral, and like you said, they want proof of payback versus based on current operations, not future. Mm-hmm. So where does that leave us? I think a lot of people in this room are probably in that position of, if you had an extra $100,000, $200,000 over a 12-month period, you could staff up, you could acquire some equipment, and go up a level in your operations. What's the best way to go? What are your options in that situation?
My first recommendation always has to be that talk to your banker about a line of credit, maybe, or if it's going to be a short-term need, line of credit. If it's going to be a longer-term need where you're planning, I'm going to hire these people, and it's going to take me a couple years to pay that back, or then get a term loan, a term working capital loan. Those are.
What's the cutoff? More than a year, 18 months, 6 months?
Well, the line of credit normally has to be paid down, or it needs to revolve, and either down to zero or down to a point, and then you can use it again. And that's what you want to avoid if If you need to invest, $20,000, $30,000, and it's going to take you 2-3 years to recover from that, you need a term loan, so you just make monthly payments and you just ding away at that. And if you have a good relationship with your banker, I would expect that they would probably offer that to you. If they won't, there are other organizations out there that would probably be more than happy to talk to you.
Do you consider signed contracts projected income, or do you consider it income?
Oh, it's projected for sure, because you have
Because you haven't fulfilled it.
you have to perform. So that's what, and that's partly what we're looking at, whether the business is new or existing, is how is it going to perform going forward? Because that's how you can pay the loan back. But yeah, signed contracts are beneficial in the loan process because it shows that you have good potential to earn the money that you say you're going to earn. But it in no way guarantees earnings.
Does CEDA or the banks ever look at the life insurance policies or even the business organization paperwork to ensure that if something were to happen, that there was a plan in place?
Yes, life insurance is sometimes part of the collateral. Depends on the situation. Because I said earlier, if your banker's totally focused on collateral, get a different banker, but they're going to want collateral. I mean, but that should be kind of almost a secondary thing. That's something we got to have. And it's usually, if you're financing equipment, they're going to use the equipment and your existing equipment. If you're financing inventory, they're going to use your equipment and your inventory. If you're new and you don't have a lot of business equity, they're probably going to require personal guarantees and a pledge of assets, personal assets, to support the loan. No.
What is, I guess, an example of good versus bad collateral, and then when does it need to be kind of focused
In
on?
my world, almost every answer is going to start with "it depends."
Of course.
There are lenders out there that do not like to lend on real estate at all. Real estate happens to be my favorite asset to take as collateral because it's not going anywhere, and I don't have time to go chasing around a bunch of trucks and log loaders and so it depends on what's the best collateral. But yeah, usually, like I say, if you're going to take out a loan to buy something, that's going to be part of the collateral. Each lender has their own loan-to-value ratios that they use. A common one for real estate's 80%. A bank won't go over that, 80% of the appraised value. So they might use your existing equipment as to fill in the difference. I mentioned earlier personal guarantees. Please be prepared to personally guarantee the loan because you're probably going to have to do that. If you want to not get the loan, tell them you won't personally guarantee the loan. That'll get you declined right now.
Now, personal guarantee, does that mean like a lien on your house? Does that mean like
It could.
Firstborn child?
Not necessarily, but we've done both at CEDA. I've had people that
Including the firstborn child?
that I trust. Now, I'll get back to more of your question here in just a little bit. Now, sometimes we do require, CEDA does, and I think it's pretty similar at the bank. If the business collateral's weaker, we might ask you to pledge your house in support of your personal guarantee. But if the business is strong and the collateral's decent and you've got a good credit history, you're probably not going to do that. To me, debt is debt. So another way to get a no is tell me I'm not willing to pledge my house. I didn't ask you to do that, but maybe the bank did, and you said, no, I'm not going to do that. Well, that just tells me that you're not committed to repaying this loan. So.
Good to know.
But anyway, yeah, stuff, real estate, depending on the lender, different types of equipment, rolling stock, trucks. CEDA does loans on logging equipment. Our counterpart to the north will not. They got burned on some rolling stock loans and they won't do it anymore. I've been pretty lucky. We just approved a logging truck loan yesterday. You know, that truck could easily end up in Indiana, you know, next week, but it's not going to, because I know that I just met these people yesterday, and we agreed to loan them the money yesterday. But he's a lifelong resident of Weehawken, Idaho. He's got family there, good credit history. He's not going anywhere. So I'm pretty sure my truck will be there if I need to find it.
And if it's not, you know who to talk to.
Yeah. So, yeah. But even your personal work history, your ability to go back to work and earn money to repay the balance of this loan that didn't get covered by everything else, that's collateral to me. And I've heard that it's been used for an SBA guarantee. We don't do SBA guarantees. So, but I've heard that they've accepted that as well. If you're employable and you got, you know, your character's outstanding, why wouldn't we trust you to repay the loan? Unless you told me you will not pledge your house. So, did you have a question? No?
Well, yeah, actually I do. So how do you determine if a business qualifies for your type of financing? Do they have to just get turned down by one bank, or is there a certain...
One's good enough.
...to 5 or 6 banks to get
No,
turned down?
one's good enough. We have, well, it's pretty easy for me to tell. I've been doing this for 26 years. But usually, where I get the applicant is from a bank or a credit union. They went there, and the banker said, well, we'd really like to help you, but for whatever reason, this doesn't meet our criteria. Why don't you go down and talk to John? And one of the checks and balances on that is my loan committee. We have a group of volunteers. They're almost all bankers. So if I start doing a bunch of deals that are bankable, they might start calling foul. I screen the applicants right off the get-go, and that's the first question I have to determine for myself, so I don't waste a bunch of time or anybody else's time, is this bankable? Why are you here? And then we have an economic development mission, so our goals are different. We're not based on profit. I need to earn enough money to support the program, the interest and the loans. That's what supports me, you know, in our program. So, yes, sir.
What are some common things you see, common mistakes, fast ways to get yourself in trouble with business debt?
Well, the most obvious is to have too much.
How much is too much?
That depends on your situation. How good are you at managing money? One might be a start. How profitable are you? Seasonality can kill you. You know, if you've got high payments and your business has a bad couple months, you still got to make the payments. So it's just going to be a case by case answer. How much is too much? And some businesses have to have debt. I mean, I have had people come and apply for loans, and at times I wonder, why do you think you need a loan? Well, the answer seems to be because businesses have loans. Well, no. If you can just go do it, go do it. You know, get your tools out of the shop, out of the garage, whatever. Go do it. Get a business license and go do it. You don't have to have a loan. But my neighbor, he just started up a machine shop. Well, guess what? CNC machines cost money, lots of money. And he was actually talking to me one day about getting a loan for his CNC machine to start his business, because that's what he did for a living, by the way. So he knew what he was doing. But he was able to go down to one of the local banks, and I suspect because of his family's relationship with that bank, they made him a startup loan with an SBA guarantee. They still got the guarantee, but they did the loan. Banks really shy away from startups because they have no proven history. There's no reason for the banker to suspect that you'll be able to pay the loan back because you don't have any history. But we CEDA, we focus more on your character, your work history, your need from the business, I guess, is another thing to bring up. If you're going to apply for a loan, the best thing you can do is clean up your finances, get rid of revolving debt. Credit card debt is, get rid of that as quick as you can. Because the less money you have to take from the business, the more we're going to be satisfied that you can pay the loan back. So, and again, you're all in business to make money, so it's not that we don't want you to earn a good living. It's we need you to pay the loan back, and that's really our focus.
One thing I've been hearing, and this is mostly businesses that sit in the 10 to 30 million a year bracket in the manufacturing side. A lot of larger businesses are trying to buy equipment because they'd rather have equipment than cash. Because even if it's a $100,000 piece of equipment, in 6 months it could be $120,000, $140,000. Some of us may be in more that startup mode where we don't have just straight cash, but we might not be able to afford something tomorrow. Is it worth using debt right now with the current cash values to make those investments? Or is that just an unwise use of debt?
First of all, if you were going to buy equipment with the expectation that the value is going to appreciate, I certainly wouldn't finance that. In my world, that piece of if it's truly a piece of equipment and it costs $100,000, the minute it hits the shop floor, it's worth $80,000. Now, I understand what you're saying because I do own a Dodge diesel pickup and I paid $30,000 for it 20 years ago, and I'm pretty sure I could sell it for almost that much today.
Yeah, exactly.
But that's not going to last. That's an anomaly. I just cannot believe that's going to be the norm.